we just went through the question, how to choose a financial professional. And we went through some different designations. We used some different tools to understand them better. We also looked at ways to evaluate, things to ask people when you're trying to understand also the different types of financial professionals there are. But I thought would be helpful, I was going through the CFA curriculum, and then there's a nice section in there on net worth segment. So you have your financial life, and you have these different stages of your financial life, and it's important to understand as you transition from your early stages to your later stages, what now tools do I need? What people do I need? What are things that are going to be very helpful? So the section broke things down into 3 categories. You have mass affluent, you have high net worth, and then you have ultra high net worth. Now the mass affluent, it still starts at 0, so that's the very beginning. You have no money, and you now are beginning the process to start saving. From there, you kind of just keep on saving up until you're about $250,000 in investable assets. Once you're at $250,000, then the next goes to $1 million. So the examples I gave in the book were showing this is what you can do from 0 to 250, and then from 250 to 1 million. Here are some important things to think about financially and people and tools that can help you during that journey. So that classification is the mass affluent. The second is the high net worth. So high net worth has also a kind of a different segment where now you're an accredited investor and you have over $1 million, which maybe gives you access to certain types of investments. From 1 million to say 3 million to say 10 million. That's how the examples are broken down in the book on like these different what are well same is because I would say once you get to 3 million, things do change quite a bit from the 1 million on the tools that you can use and the people that maybe are going to be offering the most help. And after you get to 10 million, now it's much different where a $10 million portfolio is going to sustain almost every single lifestyle there is. There's just other things that now are becoming more important. And then the ultra high net worth is the 10 million or more. They also reference people that have 50 million or more, what to do. Doesn't make up a huge portion of the population, but if you are in that segment, it does show here are some things that should be important. So what I'm going to do is just break down each of these areas and talk deeper about if you're in this area, here are the things that you want to work on, and here are the people and tools that are going to probably bring you the most value. So hopefully this is going to be helpful. I thought it was a good read, and this could be something too that can provoke questions and look a little bit more into it. All right, we're going to start off with the mass affluent, and that again is 0 to 250,000 and then 250,000 to $1 million. First thing I'm looking at is career. We are trying to build what's called net wealth. We're going over the net worth segments, but net wealth is actually a pretty important number, and I think it's underused, especially when making investment decisions. It's just the ability to earn money, and then you forecast like this is all the money you can make in your life and you bring it down. So early you have a big net wealth but very small net worth. You are trying to build that net wealth. After you start your career, well, you can go talk to your benefits person, because one of the first financial things you can do is understand what benefits am I getting through work. Am I getting a 401k or retirement package? Am I getting different health insurance packages or whatever it might be? Understand that benefits package. Third is insurance. Maybe your first auto insurance, maybe a liability insurance. Is just understand what needs to be covered, and then what stage of life, and would you want to take on life insurance or anything that may cause a big catastrophe? How can you be protected against that? Fourth is you start looking at, should I become a homeowner? When do I rent? When do I own? How do I save? All that's important too. Fifth is tax returns. Now that you're earning money, you got to start paying taxes, understanding this is how much I got to pay in taxes, and these are different things maybe I can do to start deferring those taxes. And then last ones is savings, and I put down glide path funds as an example. Is early on you want to keep your savings pretty simple because it's much more about just the act of savings. So savings is building up, say, a bucket of money that's in risk-free money that could be in CDs or just high interest rate bearing accounts. And then if you start investing, simple example of a long-term investment would be called a glide path fund. And you may see this on a 401k statement. It could be, say, the 2060 fund. And I've talked about these before, but basically it means it's a long-term investment and you can start investing in that fund with expectations of retiring in 2060. So you want to keep your investment approach simple because it's much more about just investing into it than trying to select the best fund you can. All right. Now, All that being said, what are tools we can use and what are financial professionals we can use? Well, a lot of times your company is going to have HR or 401k provider, and they can give you a lot of the information on just how you get started. This is everything you have. This is how you get started. So utilize that resource. The second resource is just different types of online resources or different types of automated resources. There's several companies, maybe even your 401k provider, have what's called robo-advisors. There's a whole section in the curriculum talking about robo-advisors and how someone that doesn't necessarily have the means to be able to hire a real-life person, here's how you can get robo-advisors. And this keeps on getting better every single year. So it is a big advantage early on that people today have, that they can get at least a good path starting. Got to be careful what you're looking at and to make sure it's accurate, but there's a lot of good quality information out there. And that brings down to the third one. If you are to hire a professional, you got to keep the expenses down. So you may look at like an hourly professional. A tax preparer would be an example of an hourly professional. You should have a very simple tax return, so it shouldn't cost too much. You maybe could hire a CFP too, a certified financial planner that would charge hourly, where you just maybe want to look once a year to say, okay, I'm using these two tools, but it makes me feel I'll pay $150 an hour or something like that for a couple hours of advisor's time to make sure that I'm doing things right in both of these areas too. A couple other things to think about is now you want to start worrying about, am I paying too much in interest? And am I getting enough interest on my investments? So interest is one of those variables that is going to save you money if done properly. Taxes, make sure that you're paying your taxes the way you should be and you're not going to get penalized or anything like that. And then as you're moving into your, say, from that 0 to 250 up to $1 million, and you start getting over that, say, maybe $500,000 to $750,000, then investing starts to become more important. And the CFA breaks down the first two areas that you look to get extra rate of return on your investments is through allocation and selection. There could be now where, all right, it's getting big enough, my portfolio, where maybe I'm at $600,000. I need to start looking deeper at allocation and selection. And then there could be a financial professional at that time that might be the right fit. That's going to choose the stocks properly and make sure that you're sitting in the right allocation relative to when and how you're going to use that money. So that's the first one, Mass Affluent. Hopefully that helps, at least with understanding these are the resources you can use and some of the things that are most important to think about. All right, we are now on the high net worth, also maybe called accredited investor. Once you pass over that $1 million that you worked really hard to save into, you're now an accredited investor, and that can mean a couple different things. But I'm going to break it down into kind of the three big bullet points that the book covered. First is you have longer time horizons. And what does that mean? It means, let's just say you have $5 million in your account. You're not going to use that full $5 million day one. You're going to space that over time and use it. You're going to take income from it. You're going to maybe buy things with it. You maybe are going to give it. It's just, there's going to be a longer period of time that $5 million is going to be used. So you got to understand my time horizons. It also opens it up to new types of investments. I'm going to say the CFA put out a whole curriculum on private wealth segments, and that's an example of a different type of investment that you can't get until you're an accredited investor. Why would you want to have it? Because it opens up a different source of return. Early stage companies that haven't gone public yet, there's a whole different risk reward profile, and you can't even get access to those investments till you at least have $1 million. And oftentimes, even if you have that much, it probably is not going to be appropriate investment. But there's different new types of investments. You have alternatives, you have options and derivatives. So you have these new choices on how should I invest and diversify my, say, $5 million. Next is then taxes and legal start becoming more of an issue, especially as you get closer to that $10 million. Certainly, every move that you make within your investments, there's taxes to think about. I've done many videos that talk about tax drag. Plus, if you are owning a business, there's different legal things that you need to have. And plus, legal can also tie into estate, meaning that if I want to give this, what's the best way to give this? I made an example, which hopefully this can be helpful. I try to keep this pretty simple. The book gave an $8 million. It doesn't really matter, but I'm just going to do a $5 million. And it still can kind of come down to more of a, how am I going to allocate these investments, and what am I expecting from these investments? Well, there might be 4 pretty big categories. So you're still going to want to have, just like any other investment, a certain amount in risk-free, say U.S. Treasury. You're going to want some of your money, of course, and maybe most of your money in just the liquid stock market, the market risk investments, where you can hold the investment in a mutual fund, an ETF, or directly hold the stock within your portfolio, but you can sell it the next day if you need to. And from there, you can have options. So options can give you income and protection. There might be different alternatives and different derivatives that you can have in addition to options. And then, like I mentioned before, you now have the ability to get into the private markets. And here's an example. What you could expect for return is, expected return is what the forecasted is supposed to happen. So it doesn't always go that way, but you always have, this is how the company or the stock or the safe investment is going to work. So say you break your $5 million, it might be $500,000 is still in the risk-free. You're good at, say that at that time you get 4%. So you get $20,000 is coming from that. Then let's just say $4 million is in your publicly traded investments, which would include the options contracts. And our objective is to get a 9% rate of return, which would basically be market risk, because it's about how fast the market's going to grow. And that would be $360,000. And then the last $500,000 is into a private markets investment. And in order to invest in a private markets, you got to expect for a higher rate of return, because it's not liquid. You can't sell it the next day. You're looking at least a 10 to 15 year time horizon is what you want to set on your ongoing private investment markets. But you might be able to draw from it for income, but expected returns to be at least 12%, and that's $60,000. So what we're looking at is this $5 million. Now we have expected return of $440,000. And that's where we want to really, the important thing to understand, and the professionals that you want to work with, you want to make sure that they have a good understanding of these different types of investments. You also want to have someone it's not necessarily just one professional. Like we've said before in other videos, you have wealth, you have taxes, and if you're in a business, you have business finances. So let's just say that now you're looking at wealth. Well, I need to make sure I understand these different levels of sophistication and types of investments. A second would be taxes. A tax person is going to be able to come up with the strategy necessary so you're not buying and selling too often, not getting yourself into higher tax brackets or getting yourself into different penalties. So you could have 2 tax advisor and a wealth advisor at the $5 million mark, and it could definitely make sense to do so. And then the last professional probably could be just, if you need to have someone that brings it all together. So $5 million is probably a little light on that, but once you get into those bigger numbers, you maybe just have what would be considered more of an advisor that is guiding you through financial planning decisions and making sure that you understand these are the types of investments that you have, and this is the type of what's going to be most appropriate for when and how you want to use the money. All right, now we are on to ultra high net worth. And we kind of skipped over the 10 to 50 million because the example in the book shows if you're 50 million plus. A lot of what you're at from, say, you have 1 to maybe 5 million, then 5 million to 10 million, 10 million to 50 million, all different segments. But once you get to 50 million, now what you're looking at is it's generational wealth, where they're thinking, usually they're thinking much more about how they're going to give their money to their within their family, how to give it to charities outside of their family. They're thinking about, like, what's going to be the use of this money many generations past myself. So it's digging much deeper into that. A lot of the professionals are the same professionals that you have with the high net worth investments, but one probably difference is now they're going to be much more full service, where basically you're kind of a company in your itself. So rather than hiring, say, a CPA firm, and you're dealing with the firm, but the firm, of course, has other clients, you may bring in a whole team of CPAs that are just working with you, that maybe specialize in whatever unique business or unique family structure that you have. So it's called family offices. So when you start getting to those higher net worth, now you're just, the journey from 0 to, say, $50 million, obviously many things are going to happen during that time. And you're going to start building up relationships, understanding when and how I'm going to bring on this next financial professional. But It's a lot of the same skill set. It still comes down to taxes. It comes down to estate. It comes down to investment strategies and investment planning. It comes down to maybe a personal CFO. All those things. As you work into now, you just have your generational wealth, and then this is going to be your own family office that they are your hire and they don't work for anybody else. So those are the three big types of wealth segments that the CFA covers. I think that certainly many people fall within that mass affluent, and then a big portion of the population does get to that $1 million part after a hard life of savings. But that $1 to say $10 million is certainly a time where now the financial professional and having the right person is going to be the good fit, and whether it's wealth, taxes, or business, if you are a business owner, just using that same criteria that we had talked about in other videos, but classifying yourself into this is probably the best fit for me based upon my net wealth segment. So hopefully this is helpful, and maybe it can bring up some more questions, which I can make more videos.